Good day, class. Ang ating pag-aaralan ngayon is about liquidity risk. At ang gagamitin nating reference dito ay ang article na sinulat ni Will Kenton noong 2023 sa Investopedia. Ang title nito ay Understanding Liquidity Risk in Banks and Business. At ito ay ni-review ni Andy Smith. Okay, so start na tayo. Liquidity risk is the possibility of an organization struggling to meet immediate financial commitments because they cannot quickly convert assets into cash without experiencing significant losses. This risk is present in both financial institutions and other companies, and it is greatly affecting their financial and operational security. Ang panganib na ito ay ang posibilidad ng isang organisasyon na nagpupumilit na agarang matugunan ang kanilang mga pangako sa pananalapi dahil hindi nila kaagad-agad na makonvert ang kanilang mga assets sa cash nang hindi makakaranas ng pagkalugi. Ang panganib na ito ay nangyayari sa mga institusyong pampinansyal at mga iba pang kumpanya, at ito ay lubos na nakakaapekto sa kanilang seguridad sa pananalapi at nakakaapekto din sa pagpapatakbo ng kanilang kumpanya. Liquidity risk is commonly divided into two categories. First is the market liquidity risk, and the second one is the funding liquidity risk. Market liquidity risk occurs when an organization cannot carry out transactions at current market prices because of limited market depth or maaring mayroong interruptions. Funding liquidity risk refers to the challenge of securing enough funds to fulfill financial commitments. Ang market liquidity risk ay nangyayari kapag ang isang organisasyon ay hindi maaaring magsagawa or hindi makagawa ng mga transactions sa kasalukuyang mga presyo sa merkado. Ang funding liquidity risk ay tumutukoy sa hamon ng pag-secure ng sapat na pondo upang matupad ang mga pangakong pinansyal o mga bayarin. Liquidity risk is a crucial factor across various sectors such as banks, financial institutions, corporations, and some individual investors. Regulatory requirements emphasize the importance of managing liquidity risk for banks, financial institutions, to maintain stability and safeguard depositors. Corporations also play a critical role in monitoring liquidity risk to ensure they have sufficient cash or credit facilities to meet their financial obligations. Managing liquidity risk enables organizations to have the necessary funds available to fulfill their immediate financial needs and commitments. Kung tutusin, required sa batas na dapat ay mayroong nakahandang pamamahala ng panganib na ito para sa mga bangko at institusyong pampinansyal upang mapanatili ang kanilang katatagan at para mapangalagaan ang mga depositor. Ang mga korporasyon ay isang critical na papel din ang kanilang ginagampanan na subaybayan ang liquidity risk upang matiyak na mayroon silang sapat na cash o mga kumpanyang mauutangan ng agaran upang matugunan ang kanilang mga obligasyon sa pananalapi. Ang pamamahala sa panganib na ito ay nagbibigay daan sa mga organisasyon na magkaroon ng mga kinakailangang pondo na magagamit upang matupad ang kanilang mga agarang pangangailangan sa pananalapi o mga pangako nila na dapat bayaran. Liquidity risk represents the challenges that a company, institution, or any other entity may face in meeting its immediate financial commitments because it doesn't have enough cash available or can quickly turn assets into cash without losing value. This risk can stem from a range of factors such as market fluctuations, unexpected withdrawals, or a sudden increase in debts. The core issue with liquidity risk is the imbalance between assets and liabilities, where assets can't be readily sold at their full value to cover short-term payments. Ang panganib na ito ay maaaring magmula sa mga pagbabago sa merkado, mga hindi inaasahang gastos o hindi inaasahang pag-withdraw ng mga kliyente o isang biglaang pagtaas ng mga utang. Ang pangunahing issue sa panganib na ito ay ang kawalan ng balanse sa pagitan ng mga assets at mga pananagutan ng isang kumpanya, kung saan ang mga assets ay hindi madaling ibenta sa kanilang buong halaga upang sapat na matugunan o mabayaran ang mga pagkakautang. Effectively managing liquidity risks is vital to ensure that cash requirements are consistently fulfilled. Strategies such as holding high-quality liquid assets, conducting detailed cash flow projections, and having a variety of funding sources are commonly used to minimize liquidity risk. Following regulatory guidelines that recommend specific liquidity standards is another proactive approach to managing liquidity risk. Ang pagkakaroon ng iba't ibang mga mapagkukunan ng pondo ay karaniwang ginagamit upang mabawasan ang panganib na ito. Ang pagsunod sa mga alituntunin sa regulasyon galing sa gobyerno na nagre-rekomenda ng mga partikular na pamantayan ay isa pang intentional na diskarte sa pamamahala ng panganib na ito. Failing to properly manage liquidity risks can have serious consequences that touch various aspects of a business. These include financial losses from selling assets for less than their value, disruptions in day-to-day operations because of insufficient cash, and harm to the company's reputation, which can worsen liquidity problems. In the worst cases, liquidity risk can push a company towards being unable to pay its debts or going bankrupt. Ang pagkabigong maayos na pamahalaan ang panganib na ito ay maaring magkaroon ng malubhang kahinatnan na nakakaapekto sa iba't ibang aspeto ng isang negosyo. Kabilang dito ang mga pagkalugi sa pananalapi mula sa pagbebenta ng mga assets ng mas mababa pa sa halaga nito. Mga pagkaantala sa pang-araw-araw na operasyon dahil sa hindi sapat na pera. At pinsala sa reputasyon ng kumpanya na maaaring magpalala sa mga problema. Ang panganib na ito ay maaaring itulak ang isang kumpanya na hindi makabayad sa mga utang nito at maaaring mabangkrap. Kaya ini-emphasize natin dito ang critical need for strong liquidity risk management strategies. Broadly speaking, liquidity risk can be categorized into market liquidity risk and funding liquidity risk. These two types of risks are linked and can amplify each other. For example, if an entity is unable to obtain short-term funding, that's funding liquidity risk, it may need to sell assets at a lower price, that is market liquidity risk, leading to a worsened financial situation and making it less attractive to potential lenders or potential investors. Ang dalawang uri ng mga panganib na ito ay magkakonekta sa bawat isa at ang isa ay maaari niyang palakasin ang isa. Kung halimbawa ang isang entity ay hindi makakuha ng panandali ang pagpupondo, yan ay funding liquidity risk, maaaring kailanganin nitong ibenta ng mas mababang presyo ang kanyang assets. Yan ay market liquidity risk. Subalit hahantong sa isang mas malalang sitwasyon sa pananalapi at gagawin nitong hindi kaakit-akit sa mga potensyal na nagpapautang ng pera o potensyal na mamumuhunan. Market liquidity risk occurs when an entity faces challenges in buying or selling assets at fair prices due to limited market depth, low buyer demand, or other market disruptions. This risk is more pronounced in illiquid markets where the imbalance of supply and demand makes it difficult to execute large transactions without impacting market prices. Selling a significant number of shares in a thinly traded stock could result in a substantial decrease in share price, leading to losses for the seller. Funding liquidity risk involves the difficulties a company may encounter when trying to acquire funds quickly to cover short-term financial commitments. This can result from poor cash management, a company's credit situation, or unfavorable market conditions that could discourage potential lenders and investors. Even reliable companies might struggle to secure short-term funding on favorable terms during times of financial instability. Banks face liquidity risks due to the imbalance between their short-term liabilities and long-term assets, such as mortgages, which can lead to potential funding challenges if depositors withdraw funds unexpectedly. This risk is heightened by the reliance on unstable wholesale funding and the possibility of sudden liquidity demands from depositors. Banks strategically manage liquidity risks by maintaining a diverse portfolio of liquid assets that can be easily converted to cash without losing value. These high-quality liquid assets act as a safeguard during times of financial strain. Additionally, banks use liquidity ratios such as the liquidity coverage ratio, or the LCR, and net stable funding ratio, the NSFR, to monitor and control their liquidity risks. The LCR ensures that banks hold sufficient high-quality liquid assets to withstand a 30-day stress scenario, while the NSFR focuses on establishing a stable funding structure in relation to the liquidity profile of the assets, promoting long-term resilience. Madiskarteng pinamamahalaan ng mga bangko ang panganib na ito sa pamamagitan ng pagpapanatili ng magkakaibang portfolio ng mga liquid assets na madaling makonvert sa cash nang hindi nawawala ang halaga o hindi bumababa ang halaga nito. Ang mga dekalidad na liquid assets na ito ay nagsisilbing pananggalang sa mga oras ng pangangailangan. Stress testing is crucial for banks to assess potential liquidity shortages in adverse market conditions. By conducting this test, banks can anticipate the impact of different stress scenarios and take proactive steps. Another important strategy is to diversify funding sources to reduce reliance on a single or limited funding sources, such as retail deposits, wholesale funding, and other financing options. A varied funding structure can enhance stability and resilience in terms of liquidity. Banks must have a strong cash flow management system in place to effectively monitor and handle their cash flows. This includes keeping track of inflows and outflows, optimizing the maturity profile of assets and liabilities, and ensuring there is enough liquidity to cover both expected and unexpected needs. Creating contingency funding plans is essential for banks to address potential liquidity shortages. These plans detail the steps to be taken in case of a liquidity crisis, ensuring a structured approach to managing liquidity in difficult situations. Asset liability management is a comprehensive strategy used by banks to balance their assets and liabilities in a way that reduces liquidity risk. It involves coordinating lending, investment, funding, and pricing strategies to ensure the bank can meet its financial obligations without facing significant losses. Corporations, similar to banks, may use short-term liabilities to finance long-term assets such as property, plant, and equipment, which can create liquidity risk. Companies with unpredictable cash flows from operations may struggle to meet their short-term obligations, especially seasonal businesses. Additionally, delays in receiving payments from customers can worsen the situation by decreasing cash flow and putting a strain on liquidity. Non-financial companies have a diverse range of business models, each with its own specific challenges in handling liquidity risks. Unlike banks that primarily deal with deposits and loans, due to the varied operational and financial activities of corporations and the lack of strict regulations similar to the banking sector, a customized strategy is necessary to effectively manage liquidity risk. Corporations commonly use various techniques to handle liquidity challenges effectively. One of these strategies involves setting up revolving credit facilities with banks. This agreement acts as a safety measure, enabling companies to withdraw funds up to a set threshold as required to address short-term liquidity issues. It is wise for companies to keep a certain amount of cash reserves on hand as a precaution. These reserves help protect the company during times of financial difficulty, allowing them to continue operating without having to take out loans or sell assets. Effective management of cash flow is essential for handling liquidity risk. By forecasting cash inflows and outflows, businesses can predict potential cash shortages and take proactive steps. Optimizing payment terms with suppliers and customers is also essential for maintaining a consistent cash flow. To reduce the risk of depending too heavily on one source of funding, companies vary their funding sources and capital structure. It may involve a combination of equity financing, debt financing, trade credit, and other financial tools. Having a diverse funding structure improves financial flexibility and lowers liquidity risks by offering different ways to access necessary capital. Managing liquidity risk is crucial for individuals when it comes to their personal finances. Unforeseen situations like job loss or a sudden decrease in income can result in inability to pay bills or meet financial obligations. Factors such as insufficient emergency savings, depending on long-term assets for short-term expenses, excessive use of credit, And a high debt to income ratio can increase an individual's liquidity risks. Unexpected expenses like medical bills or home repairs can also lead to financial strain if not planned for properly. People can handle liquidity risks by setting a sensible budget, living within their financial limits, and having an emergency fund that can cover living expenses for a few months. It is also wise to diversify investments and have access to liquid assets or credit options for unexpected financial requirements. What is the connection between liquidity risk, market risk, and credit risk? While there are different types of financial risks, they are interconnected. Market risk refers to changes in asset prices due to market conditions. Credit risk involves potential losses from a borrower's inability to repay a loan. And liquidity risk can worsen both market and credit risks. For example, a company with liquidity problems may sell assets in a failing market, leading to losses in terms of market risk or default on its obligations, resulting in credit risk. Liquidity risk has the potential to impact the broader economy in various ways. In times of financial turmoil, liquidity challenges in key financial institutions can trigger a credit squeeze, limiting access to loans and impacting businesses, consumers, and overall economic expansion. Likewise, liquidity issues in major corporations can lead to layoffs, decreased consumer spending, and a loss of investor trust, and all of which can have negative effects on the economy. What is the most effective method to assess liquidity risks? One of the most popular approaches is using either the quick ratio or the common ratio. The common ratio involves evaluating a company's current assets against its current liabilities. Liquidity risk arises when banks, corporations, or individuals struggle to meet short-term financial obligations due to a lack of cash or difficulty in converting assets into cash without significant loss. Managing this risk is essential to avoid disruptions, financial problems, and potential insolvency.